Hello everyone and welcome to your Glassnode video report for week 49. I'm your host Checkmate. We're recording this on the 7th of December 2021. So how was that? That was quite a candle. We sold off about $8.8 thousand in a single day. Now this was largely driven by a liquidation cascade, which we've all come to know and love over the course of 2021. And really this is about the intersection of how derivative markets can sometimes come in. I tend to call them the tail, whereas the spot and the on-chain markets are the dog. There are points in time when the tail can wag the dog. And essentially there's too much leverage in the system, and it really doesn't matter what is going on in any of the spot markets or the on-chain markets. Sometimes the tail just wants to wag. So what we saw is about $5.4 billion worth of futures open interest get closed in the span of less than a day. And really most of this price action happened within 1 hour. So it really was quite a dramatic move. So what we're going to look at this week is how the derivatives really push this deleveraging event and what it actually means moving forward. We'll look at the magnitude of realized losses on chain, which is an important one because obviously traders and investors are reacting to the candle as it's happening. And what we can really ascertain from that is which are the cohorts who are really affected and what does it tell us about their sentiment. And what we'll then look at things like the observations of lifespan and spending behavior and what that tells us. So that's what we're going to jump in today, and let's get started. So as I noted in the intro, it was a fairly dramatic sell-off over the weekend. And this is the other thing that just bear in mind, that liquidity and trading volume is generally lighter on the weekend. And then it's also lighter as we head into the holiday season. So as we move into December, there's just less and fewer traders who are essentially within on the markets. P&Ls are being locked in by various firms. There's a whole lot of different layers that come into this. So there is a seasonality impact, but nevertheless, we sold off from about 59,000 down to 45,000 over the course of this week. So a non-trivial sell-off. Now, much of this was driven by derivative markets. So we actually spoke about this in last week's video where we noted that there is a risk of all-time high in leverage. Now, we also noted that things like our funding rate was it was positive, but it wasn't overly beyond. It was just a little bit positive. It wasn't macro positive, right? We can actually see it here in our funding rate. You can see that it was actually declining as the correction continued. Right? It was nothing like what we saw back here in the first part of 2021. And what I really want to highlight here is that there is no maximum value of funding that's telling you that something's going to happen. We have to use lots of pieces of information to understand the big picture. So if we think about this, let's go to the complete extremes. If we have very little open interest, there's not many contracts, not much leverage in the system, does it really matter if the funding rate is very high or very low? Probably not, because what we're looking for when we have these derivative flushes, and they can be both long and short squeezes, it can go both directions, and we'll cover this shortly. But essentially, if you have very, very low leverage, there's just not as many forced buyers or forced sellers, depending on which way the market goes. Now, conversely, if you have a very, very flat funding rate, and the market's relatively neutral, but you have a near all-time high in leverage, you can still have that flush out. It doesn't really matter which direction the market is leaning, because what happens is somebody's stop loss triggers somebody else's liquidation price, which then they're selling triggers someone else's, and you get this cascade of people who are they're not selling or buying because they want to, or in this case they were selling. They're selling because they have to, and their account is being liquidated. They're essentially being flushed out of the market. So it's not something that people want to be in that situation, but when there's too many people with stop losses close to the price, and particularly after we saw a very, very strong October, we can actually see this. A very, very large amount of open interest was pulled into the market. People were going long and long and long, and as they get into more and more profit, they bring up their stop losses, they put more leverage on, they double down, they triple down, they quadruple down, and eventually you get that flush out. Now, this was about $5.4 billion that was removed over the span of a day. So it was about 25% of all of the contracts. We also saw a great deal of deleveraging in our options market, not quite to the same extent. We certainly saw options volume tick higher as traders were hedging, but also stepping in to actually capture that volatility premium. So really the derivative markets flashed across the board and we saw an enormous flush out, but by and large, this was driven by the futures open interest. So let's just zoom in a little bit on our funding rate, just to show this is an interesting little insight. So when we get these large scale corrections, generally the funding rate will go negative at the lows. And we saw that we actually did get that at the very low of this candle. Now, what that's essentially saying is that all of these forced sellers are pushing the price far down below in the perpetual markets. It's pushing it down below the index price or the spot price. So The way that perpetual futures work, there's all of these traders going long and short on leverage. Now, there's a spot price or an index price. They normally reference a number of exchanges, depends on each exchange how they do it. But essentially, in order to keep the futures contract that doesn't have an expiration date, these perpetual futures never actually expire. So how do they keep that tracking the price? Well, if the perpetual futures or the leverage contracts trade too high relative to the index price, then people who are going long have to pay an interest rate. They have to pay a premium on a regular basis every 8 hours or so to people going short. Now, the further away the index price it moves away from the index price, the higher the premium, the more people are incentivized to go short. So it creates that other side of the market. Now, when we see this, a large negative print, particularly after a macro sell-off or a very, very deep sell-off, it's generally telling us that all of that, basically the perpetual futures went down below the index price by a substantial margin. We saw this back here in September, and we saw it for an extended period of time back here in May through to July. And in general, the way to interpret this is it's a reset. It's flushed out many of the stop losses. Now, because price traded down to 45,000, even got down to 42,000 on some exchanges, essentially all of the stop losses, the leverage, all of those particular positions have been flushed out. So I think the takeaway from here is that whilst this can be quite a dramatic, and it may be very scary for many people who went through this, in general, we're now sitting at about 50,000 at the time of recording. And because we traded down to 45,000, there's about $5,000 there where most of the stop losses and liquidation prices have been flushed out. So the way to actually take home from this is that this is where spot markets take back over. On-chain data now steps in as having a much greater role, because no matter how good the on-chain may have looked, no matter how good the spot markets may have looked, when you have this much open interest and it flushes out, there's nothing that anybody can do. That is going to be the tail wagging the dog. However, now that we've flushed out 25% of the leverage, we've got a reset down to 45,000, we went negative on funding. Generally speaking, we can probably expect, again, risks can always be there, and if we start seeing open interest climb, we may have to revise this. But generally speaking, the dog is now back in control. Spot markets and on-chain now have a larger role in what's going on. So that's the framework that we're going to use as we move forward. Now, just to really capitalize, moving kind of a little bit out of the derivatives and into the on-chain space, we've got our futures long liquidation dominance and our realized losses. So this is obviously a derivative metric. What long liquidation dominance is saying is that when it's green and high, it's showing that of all of the traders who were being liquidated, more of them were longs than shorts. Now, as you would expect, when we're down near the very bottom here in July, when everybody was saying that Bitcoin was going to zero, lots and lots of people were loading up on shorts. And then they were the ones that got squeezed. So we actually moved down into short dominance. So a lot of this is a short squeeze when you see these large red prints. And these are a long squeeze when you get these large green prints. Now, what I want you to really just notice here is that people who are going long tend to get liquidated at the bottom. And people who are going short tend to get liquidated at the top. So this funny thing about markets that when people are betting big, and in general, the majority of people get these things wrong, right? This is how these people are getting liquidated because there's too many positions put on at the exact wrong time. And human psychology and trading is a very, very complex art. So people generally do get these things wrong. We get these longs getting liquidated in September, right at the bottom. And then the shorts pile on and go, okay, that's it. The market's going back to zero. And then they're the ones that get punished. So the market has this beautiful way of going towards maximum pain. Now, in this instance, you can see the dramatic increase in our long liquidation. Same here. We've essentially seen this full flush out of all of these long positions down to about 45,000. And you can actually see in both of these rallies, it was a little bit symmetrical. So as we rallied in August and then pulled back in September, we saw longs. It went from shorts being squeezed up to longs being squeezed. Then we went back to having a short squeeze, right? The shorts piled on and then we rallied. And then we had the same thing. More longs got squeezed at the top. More longs got squeezed at the top, and we've essentially had these resets each time. So it is just interesting to see these kind of market dynamics playing out where people are essentially getting flushed out at the exact wrong time. They're putting on positions late at the party when the rally is already finished or when the correction is already done. People are trading in the direction that feels the best, and generally speaking, that's where the market is actually going to start pushing and going the other direction. And on a very similar note, moving into the on-chain space, here's our realized loss. So of all of the coins that were spent over the last couple of days, and you can see that the realized losses is rocketing higher during this correction. Now, the last time we saw these was in May and then again in June. So of all the coins that were spent that day, we know the price when they last moved, when they were withdrawn from an exchange, for example. And then when they're spent again, we can say, okay, what was the price when they were moved? And then we can say, most of those coins are actually realizing losses. And on this particular day, over $3 billion worth of losses were realized. So that means that people who bought their coins at 68,000 near the top, they're then selling it down at 45, going, I cannot take this pain anymore. They send their coins into an exchange, they sell them, and that's realizing a loss between that 68,000 and the $45,000 price times their coin volume. And when you sum all of those together, over $3 billion of losses were flushed out. So you can actually see the scale of this. I mean, it's much larger than March 2020, if you can believe it. Even though March 2020 was a much bigger sell-off overall, we can see that the actual total volume, and this is a function of being a much, much higher price. So what we actually saw is $3 billion, and back here in June, we had $3.8 billion, and then during the May sell-off, which was much, much larger, $4.5 billion. So we know that some of these, whoever was holding coins and spending them on the day, were by and large realizing losses. Now, there's really only two places that those losses could be realized from. There's the topping pattern back here in the March through to April period, and then there's the recent top, right? This is where most of the coins that are being spent at a loss have to have been accumulated, because we're still trading at $50,000, which, you know, Bitcoin crashes to 50,000. If you read that headline 2 years ago, you wouldn't have believed it. So most of the coins that were actually bought up in this topping pattern were redistributed back here. There was a handful that hung on, but a large majority of them actually redistributed from May through to July. So most of these realized losses are likely to be coming from within the last month or two. So people who have actually very recently purchased, their cost basis is fresh in their mind, and then when they see this thing flush out, they panic and they distribute their coins. So what we now need to look at is, what is the overall sentiment? We know that some of these folks actually did capitulate and sell their coins. What we're now trying to assess is, has the second real major derivative flush out, the first being in May, has this broken sentiment again? Are we expecting a whole lot of people to now transition into a bearish type trend? What is the probability of this happening? So this is where we start looking at sentiment, and what we really care about is which cohorts were spending their coins and why. So one thing that's quite interesting in the HODL Waves, so the HODL Waves are a really powerful tool, and actually they're one of my personal favorite metrics. What I like about the HODL Waves, it's breaking down the total coin supply, and it's looking at it in different age brackets. So down the bottom, we've got 1 day, 1 week, 1 month, you know, and it steps up through the various months. So the green category are generally years, so more than 1 year old. And then we're looking at what I call kind of the intermediate coins, or the young coins, is in between about 6 months and down to about 1 month. And then we've got the hot coins, or coins that really were withdrawn within the last week, down here in these very, very bright red colors. Now, what you can see in these uptrends of these colors down the bottom here is showing that we do actually have an increase in the supply, right? So of the total supply, it's increased here from somewhere around 7% to just over 10%. So about 3% of the supply has recently become young. The only way that they can become young again is from being spent from these older age brackets. So what we've actually seen is about 2.63% of the supply that's younger than 3 months old has been distributed essentially since the top. So only 2.63% of the total supply has been redistributed, which is quite interesting. It's not a huge sum in the overall scheme of things. Now, when we also look at things like exchange fee dominance and our net transfer to and from exchanges. So we know that there's coins that were spent. We know that they realized losses, and that most likely means that they were purchased relatively quickly. So what we saw back here in May, right, because that's kind of our nearest comparison. It's a nice way to think about this. So we know that there's coins moving, and really what we want to look for is, are we heading into a fairly savage bear market, or are we actually going to see, are the hodlers stronger now? Are people actually stepping in, and are hodlers willing to put the floor in at a different level? What's the overall sentiment here? So what we saw in May is a very, very dramatic increase. Note how we transitioned from a outflow regime. Most of these coins are outflows, and we're talking about, 5,000 coins a day is kind of typical on these spikes. And then we moved into over 10,000, 13,000, 14,000 coins on a single day and over a sustained period of time. So all of the coins that flowed in during this May through to June, July period was about 140,000 coins. It's a lot. So that essentially all of those coins were flushed out. People who bought the top sold over an extended period of time, and it created this bearish pattern, this downtrend. And the hodlers were there. They were buying at the bottom, but at the time, very, very scary stuff, right? The chart looked very, very damaged, and it was going to take, really the hodlers had to set the floor to really bring that momentum back, which we then did. We rallied from 29,000 and we saw this fairly substantial rally through August, September correction, and then October. Very, very strong months. Now, what we're looking at in the current period, let's actually just zoom into the last year so we can really get a view on this. Note how we did absolutely, over the last couple of weeks, we did get inflows, right? 2,000, 3,000, that's the kind of range of coins. So compared to the 10,000 and the 13,000, quite substantially different. Now, notice also that we've actually had non-trivial outflows, and note that they're kind of on a similar scale. Even yesterday, if we look at yesterday's candle, which is essentially after this sell-off, we've seen 3,300 coins, which more or less offsets this particular high peak here. So there is something to be said about the difference in character between the exchange flows compared to what we had in May. So at the very least, until that kind of changes, we can put one piece of evidence into our toolbox and say, maybe it's not quite as bad just yet. Sentiment may actually be holding up a little bit better than what it did in May. Now, note also that our exchange fee dominance, so what this is looking at is of all of the fees that were spent for coins moving on chain, how many of them were associated with an exchange? Some of them are going to be withdrawals, some of them are deposits. Note how we saw a dramatic reduction, a huge reduction in dominance to exchanges. So if we start to think about that, there were certainly coins being spent and moving around the network. We saw this in our realized losses. So there was a capitulation going on. But overall, if we look at all of the volume and all of the fees that were spent, because remember, fees are urgency. If you want to sell, you have to get out. You're going to pay a high fee to get your transaction confirmed to exit your position. We actually saw a reduction in overall exchange fee dominance. So in combination with the fact that about 2.6% of the supply being distributed since the all-time high, and that's not even just talking about over the last couple of days. So relatively small supplies distribution, considering how dramatic this move has been. Relatively balanced, in all honesty, net exchange flows, and a reduction in dominance of people being really urgently trying to exit. Starts to tell a bit of an interesting story that maybe it's not quite as capitulatory as it was back here in May, where we really had people flush out and panic for multiple months at a time. If we then kind of build that up, here's where we start looking at different cohorts. So we know these coins were spent. We know most of them actually didn't go to exchanges. And we can see this on our balance in exchanges. Note how it is trading sideways. It really, and we can see that same kind of pattern. For those of you in the crowd that like the memes, it almost looks like the McDonald's sign. Maybe it is a symbol. But see how we're trading sideways, right? We're not getting that massive influx. This is what a massive influx looks like. This is 140,000 coins that then had to be essentially absorbed by all of the hodlers over a period of months. And also note, just a little sidebar before we carry on. Note how when we saw these inflows, they didn't start to withdraw until we had already started our rally. This is really showing that the market waited for confirmation, right? The market was accumulating, but it wasn't sure yet. It had the coins still on exchanges just in case. Then when we got confirmation that we started rallying, then we started to get the resumption of this downtrend. So the scale of this is very, very different, noticeably, to this. And the other one to note is that our long-term holder supply, this is where we start breaking down different cohorts. Note that our long-term holder supply, it's also kind of just trading sideways, right? It's down a very, very slight amount, but actually on the day of the sell-off, it actually ticked up just slightly. Now remember, there's always coins transitioning from short to long-term holder status because coins are accumulated every day. Some of them stay dormant for 5 months and they cross that chasm. So what it's basically saying is, because we have this relatively sideways trading for long-term holder supply, it's saying that whatever is migrating into long-term holder is being balanced by the amounts being spent, right? It's at equilibrium. But what this also doesn't look like is a mass exit where long-term holders go, oh, that's it, the bull market must be over and everything is done. So we're just trying to establish the sentiment of these different cohorts, and looking at their supply dynamics is telling us that maybe their confidence isn't quite as shaken as what it was, certainly in comparison to May, because that really is our best reference point. So then we're also going to jump on and look at these. These are two of my favorite metrics in terms of the lifespan space. Average coin dormancy, which looks at of all of the coins that were moving, what was their average age per unit BTC, so it adjusts for the amount of volume. and ASOL, or average spent output lifespan, which doesn't care about coin volume. It looks at every UTXO, every transaction, how old was it, right? So what we're looking at here is the average age, more or less, of the transaction activity during the day. Now, what's quite interesting is note how serious this downtrend is. It's been occurring pretty much since the all-time high. This is quite significant. As is in ASOL, we have a very, very strong downtrend. And actually, it ticks down during the capitulation move. So what that's telling us is that most of the coins that are moving during that period of time, it's kind of confirming our realized loss chart where they have to have been purchased recently because they're fairly young. We're seeing a reduction in overall dormancy and ASOL, which means that old coins are not being spent, young coins are being spent. So now we're really starting to narrow down. And over the last couple of weeks, we've really focused on the short-term holders as being these kind of swing traders, right? They've been stepping into the market at the lows, selling the tops, and then buying the bottom, and then seeing it all rally through again. Alongside the derivative flush, those who were actually spending and really in the spot markets creating that sell side were disproportionately short-term holders. That's kind of the main thing we can take away from this. By and large, the sentiment of long-term holders actually seems relatively untouched, right? Of course, there's always going to be some folks who panic and sell, or maybe they de-risk a little bit. We're looking at a macro view here, but we're looking at sentiment. We're trying to use the data to establish what is the most likely sentiment across the market. So the last chart we're going to look at is our short-term holder SOPR. So this is our spent output profit ratio. So where these are mapping out what is the average age of the coins that are on the move, this is mapping out just for the short-term holder cohort, how profitable were those coins. During a bull, we see an uptrend, and this shows that there's more and more profits being taken. The market has demand to absorb that. During corrections, we see this pullback. SOPR resets back down to 1 as profitable coins stop being spent, and some of those folks who bought the top cash out at a loss. We've seen the most dramatic negative print on the short-term holder SOPR, which means that on average, every single coin that was moving was realizing at least 0.95, means about a 5% loss. Now, a lot of those coins get spent, they get withdrawn, they get spent, they get withdrawn because they're changing hands all the time. These are very, very liquid coins during this period of time. So the first thing to note is that we spent a little bit of time in the negative and we've seriously pulled back. So most of the coins being spent by long-term holders at the moment are at a loss. Now, we have seen this happen on a number of occasions where you get these very, very deep negative prints. March 2020 was a good example. And we still can then resume back into an uptrend because it essentially shows a flushing out of top buyers. Now, the risk that does exist is what we saw here in May is if that creates more sellers, if the downside price action, the risk, just the fear overall, does that create more and more sell side? So this is something to really pay attention to. Look at metrics like SOPR. You can look at the ASOPR as well as a good example if you have a Glassnode account. ASOPR will give you a very, very similar picture to what short-term holder SOPR does, but it also has the long terms in there as well. And they will generally lift it up just slightly. But overall, the signals are very, very similar. And we also have these negative prints. The other ones to pay attention to are your lifespan metrics, your coin dormancy, and your ASOL. That's showing you the average age of these coins. If that starts to tick higher, that may be showing that long-term holders are getting a little bit spooked. Until that happens, it's actually telling us the opposite. They're relatively calm about all of this, which, when you're a hodler in this market for long enough, that tends to be the case. And the last one to pay attention to is our balance on exchanges. We really want to see this kind of trade sideways to even start to head back into outflows. That would show very, very constructive, a constructive view. A more bearish view would be made if we start seeing this significant inflows and it stays there. But very much so, it's about looking at many pieces of evidence and data, not just using a single metric. Now that we've had the derivative flush, that risk it's still there, but it's largely reduced. So paying attention to our open interest and making sure that doesn't just start really rocketing higher is a good sign. Generally, it doesn't. It can take a little bit of time as the market finds its footing. So hopefully that was useful. Please give us a rate, review, and subscribe, and I look forward to seeing you next week. Cheers.